Markets, particularly equities, began 2013 on a very positive note, benefiting from the removal of uncertainty with the partial resolution of the US fiscal cliff at year-end. An agreement to temporarily suspend the US debt ceiling until mid-May also reduced the risks of a policy mistake and sudden suspension of government spending. Continued signs of improving momentum in the global economy, a better than expected earnings season in the US with results approximately 5% ahead of forecasts, the announcement of further monetary easing in Japan, and significant inflows into equity funds for the first time in a number of years all supported markets. Global equity markets through January rose 4.9%, with Japan up 9.4%, the US 5.3%, and Europe 4.2%. Eurozone bonds fell 0.8%, despite further falls in peripheral yields, as German yields rose, with investors moving away from safe haven assets. With further stability in Europe, as evidenced by the return of €140 billion of LTRO funds to the ECB by banks, the euro strengthened further, rising to 136 against the US dollar. In early January, following a discussion among US Fed members over when quantitative easing programs should end, there were concerns that monetary support could be withdrawn earlier than previously expected. These fears were eased after the January Fed meeting, when it reaffirmed its intention to buy $85 billion of assets per month and confirmed an easing bias when it indicated other tools would be employed as appropriate if there was not a substantial improvement in the labour market. In Japan, the Bank of Japan announced an open-ended asset purchase program of 12 trillion yen per month, but there was some disappointment at the size and timing of the program, which is only due to begin in January 2014. Further stimulus measures are, however, expected later this year, following the appointment of a new governor, and the yen has continued to weaken in anticipation of further policy action. Globally, monetary stimulus is likely to remain in place for the foreseeable future and be supportive of markets. Data is provided on a weekly basis in relation to fund flows for various asset classes. While it is only relating to a short period of time and therefore cannot yet be identified as a change in trend, January did see a significant reversal compared to recent years with large inflows into equity funds. In the US, the third and fourth largest weekly inflows ever to equity funds since records began were seen this January. Through the first month of 2013, almost 25% of the total outflows from equity funds in 2012 were reversed. By the end of January, equity funds had seen their longest consecutive period of positive inflows since 2010. The inflows to equity funds appear to be coming from money funds and cash, and not yet from bond funds. If this pattern of positive inflows continues, it can be very supportive for equity markets. Equity markets continue to provide upside and are supported by the improving global economic backdrop, ongoing monetary support, reduction of risks in Europe, attractive valuations relative to history and other asset alternatives, and recent signs of renewed interest and inflows into equities. In Eurozone bonds, through early February, there has been some backup in peripheral yields as Berlusconi has closed the gap in the opinion polls ahead of the Italian election on the 24th of February, although a grand centre-left coalition is still expected to win and continue with the recent reform agenda. In Spain, rumours of illegal payments in recent years to the Prime Minister from construction companies have given rise to fears of political instability. We believe, however, that Europe remains on course to continue its recent progress and that the trend towards lower peripheral yields and higher core yields will continue.